Okay, we're going to look in this unit, in Unit 4, at different ways to invest and plan for your future. So, in this chapter specifically, Chapter 11, we're going to be looking at basic investing concepts and making investment choices. And then we'll look at specific types of investments and retirement accounts and things like that in the chapters in this unit. So, we're going to start here kind of broadly and then get more specific. So the first thing that we want to think about is why is it a good idea to invest? So first of all, what is investing? It's the use of long-term savings to earn a financial return. Basically, what that means is the money that you put aside to save for your long-term future is making money for you. It is actually growing instead of just sitting in a bank account. It's a proven way to strengthen your financial position over time. It's really important to provide for your future needs, and it's a source of income in addition to a paycheck. So you make money on your money, and that is always a good thing. Investing helps beat inflation. So inflation is the general rise in prices over time. As prices rise, it takes more money to buy the same goods and services. So 10 years from now, things are going to cost more than they do now. But if you are investing in an account that grows faster than the inflation rate, then that means that you are setting yourself up in the future to not have to worry too much about inflation because your money is growing at a fast rate. So there's a bunch of different stages of investing that you could think about. There's the first stage, which we've talked about a little bit, are put and take accounts. And that means basically you are taking money that you make, you're putting it in a bank account, and it's just kind of sitting there right now. And the good things about that is it's very safe. It's secure. There's high liquidity, meaning you can have that money very quickly. Then there's initial investing is step 2. Generally conservative, low-risk accounts and securities. You get a higher rate of return than a savings account, and usually the purchase prices are pretty reasonable. So that's a pretty good zone to be in. Systematic investing is step 3 or stage 3, and that would be for things like your retirement funding. So that's long-range planning. So that's where you would maybe work with an investor who can take your money, and this is generally in your 30s and 40s. Or early. That's as early as you can for retirement is always good, and that's based long-term in growth and future financial security. So you're not worried about the ups and downs of the market every day. You're more concerned with over the course of, my entire career, how is my money going to grow? Step number 4 is strategic investing. So this would be if you want to try to maximize the return on something in the 5 to 10 year range. So you want to think about how can you diversify, how can you plan, how can you hedge risk by taking your money and putting it in a lot of different types of investments that can make sure you are not putting all your eggs in one basket. And then speculative investing is the high risk. So the strategy is to get high profits. So this is where perhaps you would decide to buy and sell particular stocks, hoping that you can bet on buying something low and then having a company or business or something like that you invest in grow and explode in a good way, and then you could sell your stocks and make a lot of money. It's risky, and most people never really get there. So don't feel like you should be people who are on Shark Tank. Like, don't think you need to be Mark Cuban when you first start to invest, or maybe ever, because it's very risky, and unless you have a lot of disposable income, it doesn't really make a whole lot of sense for you. So a portfolio is the collection of the investments that you have. And you want to also think about diversification, which is spreading the risk among many different types of investments. So if you are putting all of your money into just one type of investment and that investment does not pay off, then all your money is tied up in something that's not really helping you. But if you diversify, if you put some in cash, some in bonds, some in stocks, some in maybe you buy gold or other precious metals. If one of those does well and one of them does poorly, then you can kind of even it out. If one of them does poorly, but a bunch of them do well, then in the end, you're still doing okay. So risk and return are the two major things you need to think about. Investing risk is the chance that an investment's value will decrease. There's always that risk. that exists. But the greater risk that you take, the greater potential return you'll make. So if you are taking a high-risk investment, there could be a high reward, a high return, but there also could be a really catastrophic loss. If you're taking a low risk, you may not make a lot of money on the investment, but you know you're not going to lose money either. So there's a few different types of risk. There's interest rate risk, which is the chance that, as we talked about before, maybe inflation will rise faster than your rate of interest, and you end up maybe losing money in the long run, even though your money is growing. If that makes sense. If it's not growing fast enough. There's political risk because there's things in the future that you can't control, like taxations and new regulations that might cause what you're investing in to grow or to not grow. There's market risk because of the business cycle. There's non-market risk, unpredictable events like COVID-19 or some kind of catastrophic loss because of a natural disaster. And there's company and industry risk. If a company fails, you could lose your investment, depending on what companies you invest in. There are also temporary versus permanent investments. Temporary investments are choices that will be reevaluated within a year or less. And then there's more permanent investments that you commit to for the long run, 5 or 10 years or longer. So you want to potentially try to have both. Temporary investments, generally, you're hoping for a higher rate of return. And permanent investments, you might be okay with steady growth over a long period of time. Places where you can get information about finances and all of that. I mean, number one is, to me, the internet. There's lots of great apps. There's lots of great websites that can help you with this. Investor services. So probably when you get a job, there will be some kind of investment professional who can sit down with you and help you figure out your financial future. Financial advisors, etc., are always good places to go. Corporate, there are types of investments that are low risk and low return, like bonds. So a bond is basically a loan that you would give to the government, and then the government promises to pay you back at a particular rate of interest. So it's sort of like you're the bank, and you're giving money to the government for them to do whatever they want, and then they promise to pay you back at a future date, and you know exactly how much you will make on that because the rate of interest is fixed. So that's good. You're never going to make a ton of money on bonds, but it's a very safe investment. Government savings bonds and treasury securities are different types of those. There's medium risk accounts with medium reward. A stock, depending on what kind of stocks you buy, it could be a medium amount of risk, but a good amount of return. Mutual funds is where you pull money from many investors to buy a large selection of securities. So let's say you're in a mutual fund with thousands of other investors, and they are buying all kinds of different stocks to try to diversify. That's a mutual fund. An annuity is a contract that provides the investor with a series of regular payments, usually after retirement. So if you have an annuity, you know that you're going to have some income over a period of time once you retire, typically. Real estate is another medium risk, medium return. You could buy real estate properties and rent, or maybe flipping houses, things like that. There are some risks that you're assuming. High risk are things like buying futures in companies that you really don't know how they're going to do. Maybe things like startups, buying stock options in companies that, again, you're basing all of it on if the company does well or not. Penny stocks, which would be like buying and selling really, really tiny stocks in a company, but doing it, that's like day trading, basically. You would buy and sell maybe a bunch of stocks in an hour and hope to make some money in the course of the long term. And then collectibles, things that may decrease in value over time, is sort of a high risk, high return. So that's it for chapter 11.